Why has the Bank of England cut interest rates? This question might seem perplexing, especially when inflation is sitting well above its target of 2%. It raises eyebrows and creates a whirlwind of speculation. The recent decision by the bank's Monetary Policy Committee was anything but straightforward, with an unprecedented second vote signaling deep divisions among its members. So what's really going on here? At the heart of this decision lies the jobs market. The bank is seeing a shift. Fewer job vacancies and a rising unemployment rate mean that the labor market may be exerting less upward pressure on inflation. In simple terms, the theory goes that with fewer jobs available, there's less competition for wages, which could ultimately lead to lower inflationary pressures down the line. But hold on a second. High inflation remains an undeniable reality, particularly when we look at food prices. They're set to rise even more in the coming months. And let's be real, people notice that every time they go grocery shopping. Now, let's address something crucial. The Bank of England has been busy cutting rates, 5 times in the past year alone. Yet, despite these aggressive cuts, we're not seeing a dramatic boost to the economy as one might expect. It's like throwing water on a parched plant and hoping it blooms overnight. It just doesn't work that way. The latest GDP growth prediction for the second quarter sits at a meager 0.1%. Sure, they project a slight uptick to 0.3% in the third quarter, thanks to a trade deal with the US, but let's not get too excited yet. The global economic backdrop weighs heavily on our prospects. A staggering 24% drop in UK car exports to the US last May adds more gloom to the picture. But it's not just international factors at play. Domestic dynamics matter too. One striking observation is the persistently high savings rate, double-digit levels since the pandemic. Even though wages have been rising faster than inflation, consumers seem hesitant to spend. Why? High interest rates certainly play a role, but let's be honest. There's also an underlying negative vibe from government messaging that hasn't helped consumer confidence. So what does this all mean? If consumer spending returns to normal levels and those high savings rates start to decline, we could see significant economic growth in due course. However, there's still that nagging suspicion about inflation being far from defeated. With food prices climbing and new government policies like higher national insurance contributions weighing heavily on businesses and consumers alike, we must tread carefully. Speaking of government action, let's touch on some interesting developments. There are reports of local authorities selling off council-owned buildings to tackle their massive debts, over £122 billion. Meanwhile, lobby groups are calling for urgent tax cuts while the government insists it's helping establishments instead. And don't forget potential shakeups in the property tax system to raise revenue. In July, borrowing hit its lowest figure in 3 years thanks to increases in tax and national insurance receipts. So where does all this leave us? We're in uncharted waters where traditional economic rules seem to bend and twist under pressure from various forces, both local and global. What we need now is clarity and confidence, something that cuts through all this uncertainty. The Bank of England has its work cut out for it. Governor Andrew Bailey will need to articulate how they plan to navigate these turbulent waters while addressing both inflation and economic growth effectively. In summary, while cutting interest rates seems like an easy answer to stimulate growth amidst high inflation, it's clear that nothing is simple in today's economy. It will take strategic thinking and robust communication from policymakers if we are to emerge from this cycle stronger than before. Let's hope they step up.